There's 20 stocks that analysts believe have about a 50% upside to their current share price. And that's what we're going to cover in this video. So guys, smash that like button, subscribe if you're new, and of course, drop a meow in the chat. You're watching More Money? Let's get it. What's up guys, and welcome back to the channel. And let's dive right into this one. So there was an article that said that there's 20 stocks that have at least a 48% upside to their current share price. And so you see they've highlighted a couple in the name here. So Royal Caribbean, there's Halliburton, there's Delta Airlines, and of course Meta. We've talked a lot about Meta on this channel. But no, before I show you the list, I just want to point out that keep in mind that analysts that work for brokerage firms are notoriously positive because they're trying to drum up trading volumes, right? And so they're always selling a positive narratives. And so for the entire S&P 500, they believe that there's a 21% upside potential over the next 12 months. Now, if we're going to be honest, I don't think any of us believe that over the next 12 months, the S&P 500 is going to be up 21%. So just keep that in mind. But the important thing here is look for the names where the analysts are so much more bullish than their average bullishness. So I would say if they're on average bullish by 21%, look for something that's over 40, over 50%. So that's the area where you can really gauge real bullishness from these analysts. And so you can see here, Warner Brothers Discovery is the first name that I've highlighted here, where it has an implied 12-month upside potential for its current share price of 103%. So analysts believe that in the next 12 months, this stock could double. Now you can see the other names on the list. I believe I have Generac modeled out, but I think that's the only other one in this list. And moving on to the second part of the list, so this just rounds off the 20 names, you can see that, you got Marathon Oil, you have Alaska Air as another airline there, you have EOG Resources, that's a really loved company, and then you also have Meta and Match, and so I have models on Meta and Match, and so I'll show you the models for those two. And moving into that first opportunity, Warner Brothers Discovery. So there's some very big names that have taken positions in this opportunity. And so you can see David Einhorn from Greenlight Capital and Michael Burry. They both are bulls on this name. And so why are they bulls on this name? So you can see this is what's sort of happening with this opportunity. AT&T has spun off its Warner Media segment, and AT&T shareholders, because they've spun off such a large amount of assets to Discovery, AT&T shareholders actually received a majority ownership in the newly formed company. But here's the problem. AT&T investors are dividend investors and don't want Warner Brother Discovery shares, which has been causing immense selling pressure for this spun-off security. And this is not atypical. If you spin off a business to shareholders that are not the right target audience, you will get selling pressure. And this is why spin-offs can potentially be wonderful opportunities for value investors. And that's not coming from me, that's coming from a legendary investor. And who am I talking about? Well, none other than Joel Greenblatt, the author of the book, You Can Be a Stock Market Genius. And that is actually one of my favorite value investing books. And so if you haven't read this, I'm not sponsored by this guy, but you should really check out that book. And note that in that book, he mentions that stocks of spin-off companies outperform their industry peers and the Standard & Poor's 500 by about 10 percentage points each year. And so when spin-offs get announced, it's something to really pay attention to and dive into the details there, because you could find hidden gems. And I do believe that this opportunity is a gem. And management have actually provided us with their 10-year forecast for their unlevered free cash flow, which is what I modeled out in the Patreon models. Now, the one thing that I do want to point out though is notice that their free cash flow as a percentage of revenue is actually increasing from 10% in 2022 to 15% in 2030. So there is a bit of a risk here with management's forecast. They could potentially be overly optimistic with how profitable this business is expected to be 10 years out. So just pay attention to that and let me know how you're adjusting your models to take that into account. And so where exactly does my valuation fall? Well, I did two things. The first thing is I modeled out free cash flow the way that management forecasted it. And then the second thing I did is I hedged that sort of exposure by bringing the multiple way low. So I'm using a 10 times multiple, and you can see that here. So my terminal multiple is 10 times, but despite that, and despite all of the debt on the balance sheet, which I penalize them for at $20 per share, you can see that I'm valuing the company at approximately $28 per share. And at the current share price of approximately $14.50 per share, the share price as a percentage of its intrinsic value is approximately 50%. So I do expect a double in the security. Now, this is not a recommendation to buy the securities. What this is a recommendation for you to take a look at it, do your research, talk to your investment advisor, and determine if this opportunity is right for you. Now, moving on to Meta, notice that they recently announced that they're going to be slowing hiring in 2022. And what does that mean? Well, the slowing hiring could potentially mean that the forecasted costs of revenue could come down. So I'm forecasting 71.5% cost as a percentage of revenue. But notice that there's a lot of excess costs built into that R&D line and that marketing and sales line and that general administrative line. So as Meta is looking to protect its profits, you could see the company become more profitable on a sort of gross profit level. Now, I also do believe that despite the near-term headwinds, I still believe in revenue growth for the company. And so I'm still forecasting revenue growth into the medium term at a rate of 12%, 7% in 2022, and then 12.5% beyond that. Now, can they come under that? Of course they can. Let me know what you're forecasting the revenue growth to be subsequent to this fiscal year 2022. And so where does their valuation come in? Well, you can see with a lower valuation multiple, because I think that my revenue could be a little bit sort of optimistic, so I dropped it down with a lower valuation multiple. You can see that I'm valuing them at approximately $260 per share, which takes into account the excess cash on the balance sheet. Compared to their current share price, I'm coming up to a value of approximately 60% of its intrinsic value. So that's pretty reasonable. And I do have a lot of Patreons that are buying this name right now. I'm getting close to buying Meta. I really wanted the security at approximately $150 per share, but I might just bite the bullet because I really believe in this name. There's no company that has made me more money than Meta. At least I don't think any company has made me more money than Meta. But once again, I am going to investigate those cash secured puts because there might be something very valuable for me in this environment. And I do believe that those cash secured put premiums are going to start swelling as there's more downward pressure on the market as a whole. So there might be some interesting opportunities there, which also provide me with downside risk protection in this environment. Now, that's not how everybody invests. Do what's right for you. Now with Match, notice that they have some of the best brands under management. So they got Tinder, they got Plenty of Fish, they got OkCupid, they got Match.com, and they have Hinge. Now, fun fact, I actually met my wife on Hinge. So the products do work. I found a lot of success using a variety of their products. And so I do believe in the continued success of this organization. But note that online dating is pretty normalized at this point. But I do believe that the industry is still expected to grow as they find new ways to monetize. And so notice that the Americas, I'm growing them at around 10% a year. Europe, I'm growing at approximately 10% a year. And the Asia Pacific region, I'm growing at approximately 20% for 2022. And then I bring that down to 10% thereafter. But that's the opportunity in my model. I believe that the Asian Pacific region could grow faster than that 10% is what I'm forecasting out. And I do believe that that's what the industry is forecasting out as well. But I believe in a little bit of conservatism here. I don't have any reason to support the Asia Pacific region growing faster, and they could experience a bit of a slowdown. So we'll see how this plays out. I'm watching this and I might change my model in the future. So we'll see how this plays out. And you can see that the premium valuation reflects the continued growth of the industry and their premier position with ownership of many of the top brands in the space. I do believe that many analysts do believe that the Asia Pacific region will grow at faster than what I'm forecasting in, and that's totally understandable. So with a terminal multiple of 20 times earnings, I'm valuing them at approximately $50 per share. Now, they don't have a great balance sheet, so you'll see that I'm penalizing them at $11 per share for that debt that they have. So personally, I believe that the share price is on the fairly valued to overvalued side, and so Match.com is not necessarily an opportunity that I'm diving to in this environment. Now, how do you get access to all those models? You can get access to all those models at the lower tier of the Patreons. And if you want to join us for an epic live presentation every month, you can join us for our live Zoom calls at that upper tier of the Patreon level. And I reserve my best work for that call each and every month. Now, Warner Brothers is not the only spin-off opportunity that I'm investing in right now. In fact, my number one opportunity is actually a spin-off opportunity, and I talk about that right here.